If you were born before 1966, stop whatever you are doing right now because what the Social Security Administration is not going to tell you could permanently destroy up to 30% of every single check you will ever receive for the rest of your life. And the 2026 rule changes make this more dangerous than it has ever been. So stay locked in because the most critical warning in this entire video is coming later and you cannot afford to miss it. The SSA will process your claim, smile at you, hand you your paperwork, and never once whisper a single word about the permanent financial trap that is built directly into the system for anyone born before 1966. And right now in 2026, that trap is wider, deeper, and more expensive than it has ever been in the history of the program. There are 4 specific birth year groups that each face a completely different set of rules, completely different penalty structures, and completely different windows of opportunity. And if you do not know which group you are in, you are flying blind with your retirement security on the line. So here is what I need you to do right this second. I need you to think about your birth year. Were you born between 1960 and 1965, between 1954 and 1959? Were you widowed and born before 1960? Or were you part of the workforce in the 1980s and 1990s, when the SSA had a documented history of processing earnings records with critical errors? Because the group you belong to determines exactly how much money is at stake, and for some of you, the number is not just significant, it is life-changing. We are going to go through all 4 groups one by one with the kind of clinical precision that the SSA absolutely refuses to give you, and I promise you that the single most powerful and most overlooked rule in this entire breakdown is coming toward the end of this video. So do not you dare click away, because what I reveal in the final minutes of this video is the one thing that is costing ordinary seniors over $100 every single month for the rest of their lives, and it is completely preventable. Let us start with Group 1. And Group 1 applies to anyone born between 1960 and 1965. If you are in this group and you are thinking about claiming Social Security at 62, you need to hear this like your financial life depends on it, because it does. Claiming at 62, instead of waiting for your full retirement age, triggers a permanent reduction of up to 30% on your primary insurance amount. This is not a temporary adjustment. This is not something the SSA will reverse when you turn 67. This reduction is baked into every single check you will receive until the day you die. Let that land for a moment. If your full retirement age benefit would have been $2,000 per month, claiming at 62 locks you in at approximately $1,400 per month forever. That is $600 every single month, gone permanently. Over a 20-year retirement, that is $144,000. Over a 30-year retirement, that number climbs to $216,000. And the SSA will not call you to say, hey, you might want to reconsider. They will just process the claim and move on. Now, for Group 1, there is also the earnings test that is absolutely destroying people in 2026. If you claim early and you are still working, the SSA will withhold $1 in benefits for every $2 you earn above the 2026 earnings limit, which has been updated and is catching people completely off guard. And here is the part that most people in Group 1 do not understand. Even after you reach full retirement age, the SSA will recalculate your benefit to credit you for the months they withheld, but the permanent age reduction from claiming at 62 does not go away. You are still locked in at that reduced percentage. The only way out of this trap for Group 1 is to file a withdrawal of your application using Form SSA 521, and you must do that within 12 months of first becoming entitled to benefits, and you must repay every single dollar the SSA has paid you. If that window has already closed, the damage is permanent. So if you are in Group 1 and you have not claimed yet, you have time to avoid this, but that window is shrinking, and the 2026 updates make the math even more unforgiving. Now let us move to Group 2, and this is where a massive amount of money is being left on the table by people who do not understand the power of delayed credits. Group 2 covers anyone born between 1954 and 1959 who has reached their full retirement age but has not yet claimed. If you are in this group and you are holding off, you may be doing the single smartest thing you can do with your retirement strategy, because for every single year you delay claiming past your full retirement age, your benefit grows by 8%. 8% guaranteed growth, no stock market risk, no volatility. 8%. If your full retirement age benefit is $2,000 and you delay for 3 years to age 70, your monthly check becomes $2,480, and that higher amount is what all future cost of living adjustments are calculated against, which means the gap between claiming early and claiming late compounds over time in a way that is genuinely staggering. But here is the urgent warning for Group 2 that ties directly to the 2026 rule changes. The delayed retirement credit stops accruing at age 70. There is a hard stop. If you are already 70 or approaching 70 and you still have not filed, you are not accumulating any additional credits. You are just leaving money sitting on the government's table every single month you wait. The SSA is not going to send you a letter. They are not going to call you. They may send you a general notice, but there is no aggressive outreach to say, listen, you have maxed out your credits and you need to file now. For Group 2, the retroactive payment strategy also matters enormously in 2026. If you are past full retirement age and you file now, you may be able to request up to 6 months of retroactive benefits, but here is the catch that destroys the math for a lot of people. Those retroactive months are calculated at the benefit rate you would have received 6 months ago, which means you lose 6 months of delayed credits in exchange for a lump sum. Whether that trade is worth it depends entirely on your specific numbers and your health situation, and the SSA absolutely will not run that calculation for you. You have to know to ask. Now I need you to stay with me because we have 2 more groups to cover, and the information coming up is more urgent and more specific than anything I have shared so far. Group 3 is for widows and widowers, specifically those born before 1960, and this group is the one where the most catastrophic errors are happening right now. If you are a widow or widower, you have access to 2 separate benefit streams. You have your own retirement benefit based on your own earnings record, and you have your survivor benefit based on your deceased spouse's earnings record. The rules for claiming each of these are completely different, and the ages at which you can claim each one without penalty are completely different, and the SSA almost never explains this dual stream strategy clearly. Here is the core rule for Group 3. You can claim your survivor benefit as early as age 60, while simultaneously allowing your own retirement benefit to grow until age 70, and then you switch. Or you can claim your own reduced retirement benefit early and switch to the higher survivor benefit at your full retirement age. The comparison between these 2 paths can easily represent a difference of $300 to $500 per month for the rest of your life. Most widows in Group 3 are either claiming both at the same time, which permanently locks in a reduced survivor benefit, or they are claiming only one and never making the strategic switch at all. There is a specific form situation here that matters. If you believe you are receiving the wrong survivor benefit amount, you can request a review, but you need to act before the statute of limitations on corrections runs out. And in 2026, the SSA has updated its processing timelines in ways that are compressing that window. I am going to tell you in just a moment about the single biggest mistake that is costing seniors over $100 every single month, and it applies to every single group. But first, I need to make sure Group 4 understands their specific time-sensitive situation. Group 4 is anyone born before 1966 who was working during the 1980s and 1990s, and this group may be sitting on a ticking financial time bomb right now and not even know it. During those 2 decades, the SSA had widespread problems with accurately processing and recording earnings data. Employers reported wages on paper forms. The SSA entered them manually. Errors happened constantly. Wages were credited to the wrong accounts. Entire years of earnings were simply missing from records. Earnings were transposed, underreported, or attributed to the wrong Social Security number. And here is why that matters in the most direct financial way possible. Your Social Security benefit is calculated using your highest 35 years of indexed earnings. If even one or two of those peak earning years from the 1980s or 1990s are understated in the SSA's records, your calculated benefit is lower than it should be. And if you are already collecting benefits based on an incorrect earnings history, you are being underpaid right now every single month. The SSA is not going to audit your record. The SSA is not going to find these errors. You have to find them yourself. And right now, I want you to go to ssa.gov and create or log into your My Social Security account and pull your Social Security statement. Look at the Earnings History section, which lists your reported earnings for every single year you worked. Go back to the 1980s, go back to the 1990s. Compare those numbers to your old tax returns, your W-2 forms, any old pay stubs you still have. If you find a discrepancy, even a small one, even a year where your reported earnings seem slightly low, that discrepancy could be costing you money right now. And here is the number that I want burned into your memory before we get to the most important revelation in this entire video. $1,000 of unreported earnings from a peak earning year in your record can reduce your monthly benefit by over $5 per month. That does not sound like much until you realize that most errors are not $1,000. Most errors are $10,000, $20,000, or in some cases an entire year of earnings that simply does not appear on the record at all. An entire missing year from a high-earning decade could reduce your monthly check by $100 or more every single month for the rest of your life. And that brings us to the correction process. The form is SSA 7008, which is the Request for Correction of Earnings Record. This form exists specifically for this purpose. You file it with documentation supporting your corrected earnings, including copies of W-2 forms, tax transcripts from the IRS, or employer records if you can obtain them. The IRS can provide wage and income transcripts going back many years that you can use to support your correction request. But here is the absolute critical warning that applies to every single person watching this video right now. Your ability to correct your earnings record becomes significantly more complicated and in some cases impossible after a certain period, and the SSA is not required to give you retroactive payments going back beyond specific timeframes once the correction is accepted. This means that if you have been collecting a reduced benefit for years due to an earnings record error and you only discover it today, you may not be able to recover all of the money you were owed. You can get your benefit corrected going forward, but the past money may be gone, and that is the single most infuriating and financially devastating truth in this entire video. The SSA will not tell you your record has an error. The SSA will not tell you how much you are being underpaid. The SSA will process your claim with the data they have, pay you based on that data, and that will be the end of it, unless you take specific affirmative action to audit and correct your own record. Every day you wait is another day you are potentially being underpaid. Every month that passes without auditing your earnings history is a month where that $100 or more is gone and cannot be recovered. Now, I want to bring this all together for you with the single most important rule in this entire video, the one I have been building toward since the very first second, and this applies to all four groups equally. The most powerful and most underutilized tool in the entire Social Security system right now in 2026 is the combination of the My Social Security online account at ssa.gov, the official SSA 44 form for reporting income changes that affect Medicare premium adjustments, and the SSA 7008 for earnings record corrections used together as a coordinated audit and optimization strategy. Here is why this matters so much right now. The 2026 Medicare Part B income-related monthly adjustment amount, which is the income-based premium surcharge known as IRMAA, has updated thresholds that are directly tied to your reported income 2 years prior, which means your 2024 income is determining your 2026 Medicare premiums. If you had a one-time income event in 2024, a retirement, a pension distribution, a sale of property, that temporary spike in income may be causing you to pay higher Medicare Part B premiums right now in 2026, even though your current income is much lower. The SSA 44 form allows you to report a life-changing event and request a reduction in your Medicare premium surcharge based on your current lower income rather than the higher income from 2 years ago. Most seniors in all four birth year groups who are affected by IRMAA do not know this form exists. They are paying hundreds of dollars per month in excess Medicare premiums that they legally do not owe. They are just paying because the SSA never told them there was a form to fight it. For some households, this represents $1,200 to $3,000 per year in preventable Medicare premium costs. And when you combine the IRMAA correction with the earnings record audit and the strategic claiming decision that is right for your specific birth year group, the total financial impact can reach tens of thousands of dollars over the course of a retirement. This is not theoretical. This is not a hypothetical. These are real rules, real forms, and real money that is either going to stay in your pocket or be left on the table, depending entirely on whether you take action today. So, here is exactly what I need you to do before this video ends. Go to ssa.gov right now and log into or create your My Social Security account. Download your Social Security statement and go directly to the Earnings History section. Compare every single year of reported earnings against your own records, your tax returns, your W-2 forms. Anything you have from the 1980s and 1990s especially. If you find any discrepancy at all, print out the SSA 7008 form and begin the correction process immediately with whatever documentation you have. If you are currently paying Medicare Part B premiums and your income dropped significantly due to retirement or any other life-changing event in the past 2 years, print the SSA 44 form and submit it with documentation showing your current income level. If you are in Group 1 and you have not claimed yet, run the numbers before you claim, because that 30% permanent reduction is not a scare tactic. It is printed in black and white in the Social Security Act. If you are in Group 2 and you are past your full retirement age, check your delayed retirement credits, and if you are near 70 or past 70, file your claim this week. If you are in Group 3 as a widow or widower, request a dual benefit comparison in writing from the SSA and document every interaction. If you are in Group 4, treat your earnings record audit as the most important financial task you have this year, because the money you find there belongs to you and you have already earned every single dollar of it. These deadlines are not flexible. These windows do not reopen. The SSA processes millions of claims every year, and they are not going to stop the line for your situation. You have to be the one who knows your rights, knows your forms, knows your birth year group, and takes action before the window closes. If this video opened your eyes to something the SSA was never going to tell you, hit subscribe right now, because every week we go deep on the rules, the loopholes, the correction strategies, and the claiming decisions that the government counts on you not knowing. The seniors who protect their benefits are the ones who stayed informed, and the money that is still on the table today will not be there forever.